Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to small cap fund manager Ken Wotton of Gresham House. So, welcome, Ken.
Hi, Paul. Thanks very much for having me.
Yeah, well, we've got quite a lot of cross currents on the markets at the moment. We've got the ongoing war in Ukraine. We've now got a crisis in the Middle East. We've had a smattering of profit warnings as well, offset by falling inflation. We've had a splurge in M&A and all things sort of small cap on our name recently. And now we've got expectations of interest rates falling later in the year. So putting all that together, what's your sort of outlook for equities into 2024, particularly your sort of sweet spot of small and mid caps?
Yeah, I think, as you rightly pointed out, there's a lot going on in the wider world, and the sort of the macroeconomic and geopolitical environment. There's lots of reasons to be pessimistic as a result of that, but I don't think that's sort of not been the case for the last sort of multiple years, and there's always something which is you could latch on to be worried about. We try not to focus too much on the macro, be aware of it and how it might affect individual companies, but really try and just find good quality companies. And so, in the context of good quality companies, we still think there are lots of them on the UK stock market. And the good thing from our point of view, if you're looking for opportunities in this environment when sentiment is wobbly, is that there's loads of good quality companies trading at pretty attractive valuations. And if you take a long enough view, then you should be able to make money out of that, notwithstanding the short-term volatility. So in answer to your question about 2024, yes, there's lots of reasons to think that we're probably still in for a bit of a volatile ride. But I think the valuations and the exposure the valuations are getting through the takeover activity we're seeing in small and mid cap, I think really could be a catalyst for some quite interesting performance in the smaller end of the market this year.
Good. Okay. Well, let's dive into one of those stocks, which actually is probably a real beneficiary if we do start seeing an increase in sort of IPOs and secondary listings and private equity houses also having to then convert some of the or list some of their companies. Let's move to Peel Hunt, which is basically a boutique investment bank in the UK for small and mid caps. Can you take us through the sort of logic on this one? Because amazing enough, I was surprised it's still profitable actually, even though that's sort of like a really tough 2 years.
Yeah, look, it's I'd say Peel Hunt, who are a counterparty that we deal with as a small cap investor, as all of our peers would as well. They are one of the top tier players in small UK small and mid cap, along with the likes of Numis and Investec, and there's been a lot of pressure in the market because of the lack of deal flow. There's been sort of pretty sparse set of IPOs since 2021, which is a big generator of fees. But we think Peel Hunt are kind of one of the long-term winners in the space, and part of the reason for that is they're not just reliant on deal fees. They're also they have very strong market making and trading capability, which and particularly they're well connected in with sort of retail platforms, which means that they get flow. So that business is a bit more kind of run rate and recurring. And actually, in periods of market volatility, there's more activity sometimes for them in that area. So it tends to offset some of the kind of cyclicality of the deal part of the business. And as with all of these sort of mid-cap brokers, they are diversifying their offerings and starting to do things in private markets and M&A, which also are somewhat sort of different in terms of their exposure to the cycle. We invested in it knowing that it was potentially exposed to market volatility and being prepared to see potential share price weakness when people were sort of cautious about markets. And but viewing that as an opportunity to buy. And if you take a sort of 5-year plus view, we think this business is going to take market share. And with things like Numis being taken private by Deutsche, we think that's an opportunity for Peel Hunt. So we're not making a call on the market by investing in Peel Hunt, but when things pick up, they should be a sort of beneficiary of the cyclical upturn, as the share price has been weak on the back of the cyclical downturn.
Yeah, and also you raise that really good point is that it's an undervalued asset, but you've got the optionality of it could well it'll either be an acquirer or get taken out, because you say I think it was one of the is it Deutsche Bank bought Numis, and you've had Cavendish which is basically Senkos and FinCap, isn't it, together?
Yeah.
So
Yeah.
you're right.
And
Good.
then Libra and Panmure is the most recent sort of announcement as well.
Yeah. Okay, good. Well, let's move on to another one in the sort of the financial markets. We've got Argentex, which has been a lot of news just going off around there. We've had quite a lot of management change. About 3 or 4 months ago, both the FD and the CEO left. So we've got an interim CEO and interim CFO at the moment, new chairman, Nigel Railton, I think it is. And they're doing a strategic review. What's sort of your take on what's been happening? The shares have come down. They do look unbelievably cheap, given they've got a rock solid balance sheet, and they trade. I mean, it's difficult to know, but probably around about 7 or 8 times PE on very low earnings.
Yeah, this is a business which we were an early investor in Alpha what's called Alpha FX, now Alpha Group, which is sort of doing. Certainly has some significant overlap with Argentex, and then after we sold that, Argentex came to the market, and we were a participant in the IPO because we really believe in this area of alternative foreign exchange sort of hedging contract providers and consultants, because there's a big structural shift going on where there's a move away from the sort of typical banks that would provide this sort of service to a more consultative rather than a kind of transactional based approach. So we think the market opportunity is really, really strong. The business was founder led when it IPO'd. There were two co-CEOs and the 2 founders. One of them stepped back after COVID, and the other one has relatively recently stepped back. So it's going through those sort of growing pains and the transition pains of moving from founder-led business to professional manager-led business. But we still think the opportunity is there. As you say, the balance sheet is strong, so it can withstand sort of short-term sort of, I guess, volatility in its own business. And it can, it should be a beneficiary of the long-term structural trends that it's sort of happening in its market. As you say, you can buy it on a single-digit P multiple at the moment. We think that's pretty compelling value over the next few years.
Yeah. And if a company gets into sort of like, difficulties, I think you're reasonably sized shareholder in this business.
Yeah.
Is one of sort of the beauties of Gresham that you're sort of like, at least give the company a bit of a nudge into what they may consider for their strategic review, presumably.
Yeah, we are. We sort of describe our approach as active engagement. So we're not activist investors. We're not trying to sort of go and shake things up and sort of cause issues. We're trying to be supportive, collaborative shareholders, but we're more engaged than a typical market investor would be. And where we've got high conviction in the opportunity and the strategy and the potential for value, then we're happy to take bigger equity stakes to support that, to sort of put our money where our mouth is in terms of conviction, and that Argentex is in that category. So I won't go into the sort of specifics of what we think should happen, but we're certainly in active dialogue with the chair there to sort of make sure it's on the right path.
Good. Yeah. I mean, certainly when it comes to sort of fund managers, I think that's fantastic because, with the sort of the shift towards all things passive, then active or effectively active engagement, certainly it means that, yes, you've got the stock picking active, but you've also got, if things don't go right, which clearly everything goes perfect, nothing goes perfect all the time, then, you roll your sleeves up. That's good. Okay, well, let's move on to a fund manager that's got another one, sort of a rock star exec chairman. Let's move to Assetco, which has got Martin Gilbert, the ex Aberdeen Asset Management. It also has Christopher Mills of Harwood Capital, big active engagement fund manager on the board there. It seems to be a bit of an unbundling play. They've got cash. They seem to have the River Capital business, River Global, business, which was the R&M, and then they also have a 30% stake in Parmenion. Could you take us through the sort of like how you see this one going forward? Because it does seem pretty cheap, actually.
Yeah, I agree. It's cheap. I mean, we were shareholders. We're not currently shareholders in this one.
Okay.
We inherited our stake that we did have as part of the River and Mercantile takeover that they did. So there was a takeover which was part cash and part equity consideration in Assetco. So we stuck with it for a while because fundamentally we believe that the sort of sum of the parts valuation for this business is sort of gets you to a number substantially above the current share price. But because we only had a relatively small stake, because it was in it came through that transaction, we sort of had to take a view: do we buy significantly more, or do we exit and get liquidity and sort of find something else? And I think the difficulty the business has got is that it has cash and it has some really interesting assets. The Parmenion stake probably be the most valuable one, but it's a tough market out there, and so there should be opportunities, but unless they can realise the Parmenion stake at a sort of an attractive value, somewhere where close to where the management believe it should be worth, then recycling that capital into the opportunities that are around at the moment is quite tricky. Apologies, there's a bit of a background siren.
Don't worry, it doesn't matter.
So look, I think it's got a highly credible management team. It's got a balance sheet to do things, but it's a tough market to you've got to be very careful about what you buy at the moment, because particularly in the open-ended fund space where they've got some exposure. It's particularly acutely sort of exposed to market movements and market sentiment, which might mean it's a great opportunity to buy things, but you've got to be pretty careful about kind of keeping your eyes open when you do.
Yeah. Good. Okay. Well, let's move on to another sector. We've got software and tech services. Another one you've stuck with through thick and thin is ActiveOps, which does basically automation software, largely for the financial sector. So for banks and for commercial banks, that is, and insurance companies. I think it has nationwide, and it helps sort of like big back office workforce, both on a in office and in a hybrid perspective, to get more productivity out of them. Can you take us through this one, because it now does seem to have reached a bit of a tipping point whereby it's EBITDA positive and still got a rock solid balance sheet?
Yeah. So this is one which floated, I think it was in 2021, when the market was booming and when all things tech and growthy were sort of being valued very highly. And we liked it then. We invested in the IPO, but we've added a lot subsequently. We liked it because it's a sector which we think has got some really strong structural drivers. It's basically a business process automation play, and there's lots of different software companies playing into that theme, and it's a global business, so it's a global theme, so the market opportunity is pretty significant here. And as you say, they've got high quality, big name customers that are trusting them to implement this software into business critical processes. It floated on a recurring revenue multiple of around 5 times back in 2021, which at the time was sort of not a stretch relative to other sort of transactions and listed companies in the SaaS space. It's subsequently been derated as the market has shifted from growth to value. And
it's about 2.3 at the moment.
Yeah, and so this is, in our view, that is just ludicrously the wrong price based on the long-term prospects of the business. As you mentioned, it's now they're taking the step to dial back the investment in growth in order to demonstrate that they can be profitable, which was key part of our thesis. This is fundamentally a profitable company. It's investing to grow, and so the bottom line is not showing that at the moment, but they could be profitable if they wanted to be. They're now showing that is actually true, and so this is a stable, robust business with a profitable, with a strong net cash balance sheet in a fantastic market with good structural drivers. So what's not to like? And it's now being valued at a discount to what for decades kind of cash flow buyers were buying sort of recurring revenue software businesses which weren't SaaS. So they were buying them for 3 times and just trading at a big discount to that. So I just think you get your money back quite quickly if you just hold on to this from the cash generation.
Yeah, and also it's probably in the crosshairs of some sort of like private equity software roll-up, I guess. And it's also got I think it's got quite an interesting AI component to it, hasn't it? Because it's adding more AI features to its services, which should help its customers, I guess.
Yeah, and I'm sort of careful to try and get past the AI hype and everyone.
Okay,
I think everyone has to say they're doing something with AI now, and I'm sure they are a sort of pretty switched on management team, and they're very tech savvy, so they will be using the tools that are available to them to try and enhance and augment what they're doing. And I think every business should have a view about how AI and generative AI in particular is going to affect their business. And but ultimately, I sort of view it as these are tools which have to be pointed in the right direction by humans and companies that have customer relationships, routes to market, and fundamentally is solving a real world issue. And these tools will be massively sort of empowering to either do that more efficiently or more scalably, or kind of do things a bit differently. So everyone should be doing something, but that's not the fundamental reason for me buying this stock. It's just because it's a good business in a good sector at a cheap price.
Okay, well, I won't mention AI, even though it's appropriate for the next one, which is Fintel, which is basically a financial data services provider supporting IFAs, product providers, people like Schroders, and investors with better information about how to, firstly, for sort of product providers, how to actually distribute their particular products. For IFAs, how to advise them in an increasingly tighter regulatory world with sort of the consumer duty. And then people, idiots like me, like investors, who just basically need more information about what funds to buy and products to buy. And that may also be, insurance things for things like, or mortgages or whatever. So do you want to take us through this one? Because it hasn't really seemed to have put a foot wrong, actually, since I think it came to market about 3 years ago.
So yeah, it was originally it came to market.
Oh, a long time ago. It was Simply Biz, wasn't it?
I was going to say 6-7 years. It was called Simply Biz when it floated.
Yeah.
And at the time when it floated, it was a provider of outsourced compliance and technology services to IFAs, particularly the sort of smaller IFAs that could kind of plug into their sort of economies of scale. And over time, it's evolved. It bought a business called De Facto, which was a sort of fund research and data analytics platform. And using that acquisition, they effectively are on a transition from being a one-sided service provider to being a double-sided platform, effectively a tech and data platform. So and you rightly described that they're serving the IFA community, fund buyers on one side, giving them information and access and data on product providers and what's appropriate for their clients, as well as sort of hand-holding through the regulatory processes. But on the other side of it, they're able to sell that sort of data and insight about what fund buyers are doing to the product providers, so they can tailor their products more effectively to be more sort of in line with
end-to-end service.
Yeah, exactly. So and at the moment the business is being is sort of on a transition, so it's improving its quality of earnings. So the proportion of software as a service or contracted recurring subscription revenue is increasing significantly. So better visibility of earnings, and its margins are going up. Its cash generation is strong. It's got a strong net cash balance sheet now. When we first invested, it had net debt, but it's paid all that off now. And we think that the multiple will ultimately reflect this platform positioning rather than being a kind of a service provider to an area of the market which people kind of might worry consolidation is going to erode their opportunity, but actually they're selling to all the big consolidators now, as well as the small IFAs, and they're really, I think, demonstrating that they're doing what they said they would do. They're also augmenting the growth by buying some small fintech businesses, which I guess have probably run out of funding from the VC market, and so they're able to buy them on attractive prices and plug them in. So adding capabilities to the platform, once you've got the customers on both sides, then adding functionality can support growth. So yeah, really exciting.
Yeah, it does look to me a bit of a no-brainer, that one. Now it's moving on to another one which has been sort of like in the headlines for quite a lot, is Tribal Group, which is basically a software provider to the higher education sector, doing sort of like, universities, helping them to sort of like do, managing their operations and degrees and stuff. But it also does, I think, it's exam testing services in the UK as well. This one sort of like I think it was a bit of a flagship sort of contract out in Singapore with the university out there. And unfortunately that went pear-shaped, and that sort of cancelled. What's your sort of latest on this one? Because it did receive a bid approach at 74p. That one then got rebuffed, and it's now trading at 42.
Yes. So
long short.
There's been quite a bit has gone on. I think the Singapore contract that was a sort of onerous contract was clearly a negative for the story, and it's cost them financial. The opportunity cost that not making that work is quite significant, because it was a gateway to other potential contracts in Singapore as well. and there's a sort of potential liabilities around the sort of litigation around the contract. So it's not been good, but it's quantifiable. They've provided for the sort of what they believe is the worst case scenario. It's out there, and I believe that issue is priced in. The shares fell significantly as a result of that, sort of back early last year. And as you rightly say, they've then received a takeover offer. So from a private equity backed trade player actually, and 74p relative to where the share price had been prior to that, and given the context with that Singaporean contract, we thought was a pretty decent outcome. So we were supportive of that transaction. They have a large shareholder, Genzibar, who are a trade player as well, who's a sort of strategic investor,
Right.
and they weren't happy with that transaction. Obviously, we're not party to what their sort of specific views are, but whether it be price or kind of the ultimate buyer, which would have been potentially viewed as competitive, they weren't prepared to support it, so they voted against. My view is the fundamental attraction of this business for a trade buyer is still there. They've got a fantastic market position in that higher education sector, and that's what the buyer was looking to tap into, because these contracts they're very long term in nature. They're very sticky when they go right at sort of ex Singapore. Then you've got these customers for a really long time, because the sort of student administration platform, which is the base of what they provide, you just don't change that very often if it's working properly. So we think they've got a really valuable asset here, and ultimately that it's likely that this business will be acquired in the longer term, whether it's by their large shareholder or by somebody else at a price which the large shareholder is prepared to accept. So we think it's a good value at 42p with it, but it will take some time to get back up to 74.
Yeah. I've seen it quite a few times actually. We've had a couple of trade buyers who are sort of like, not agreeing on particular price, and then 2 or 3 years later they sort of consummate a marriage. So that's sort of like a work in progress, isn't it? Okay, let's move a bit smaller down into the micro area, which is I think it listed a couple of years ago, Silver Bullet Data Systems, which is really sort of like doing software and services for sort of advertising and promotion, but it's got a new sort of, I think it's a 4D AI sort of product that helps corporates improve the efficiency of their promotion and targeting of their promotion and ad marketing to consumers in a sort of like a new banned cookie environment with the Google. Do you want to take us through this one, because it's obviously it's got a fair sort of like head of steam at the moment?
Yeah, so I mean they've been doing a good job of winning contracts and sort of getting commercial traction. When we first invested in it, which was a couple of years ago, when it came to the market, what we liked about it was that it had a services business, so effectively consultants advising businesses on digital transformation and how to kind of market their services in a digital environment. So, which was a growing business, and it was a profitable business. And then they had 4D, which was a software business, which, as you say, is using sort of machine learning and AI tools to help in a programmatic advertising, so in digital marketing sort of setting, to understand the context of where your ads are going to be served and ensure that they're going to be brand appropriate, and also sort of serving them to the most effective audience that is going to be most likely to engage with your brand. So really exciting, and as you say, it's set up for a first party data environment. So where when cookies are being sort of phased out, this product enables people to be able to navigate the environment without having cookies. I think it sort of it suffered a little bit, because that, although those changes were well telegraphed, the implementation of them took a bit longer than people anticipated, and so customers were waiting. They were testing the software, but they were waiting until it was a bit clearer how the landscape right before really committing to sort of spend significant amounts on it. It feels like that's starting to happen now. So it's an area, the marketing services market, in aggregate, it may be cyclical, and marketing spend ebbs and flows. Digital marketing is now the majority of the market, so that is now ebbing and flowing more than it was a few years ago, when it was kind of displacing some more traditional advertising. But this business, it's doing something very specific, which really fits in with the kind of way the market's going, and it's got fantastic customers. Heineken is a big customer, for example, and So big global advertisers think this technology is got something sort of bit different, bit special, bit unique. So that could be really, really valuable if they really continue to demonstrate some good traction. So yeah, it's a interesting little business, which hopefully will turn to an interesting big business in due course.
Yeah, well, I would highlight to investors actually. Last week there was some big results out from Meta, the old Facebook business, and they adjusted to the new non-cookie tracking environment a few years ago because they got absolutely killed by the Apple ban on the iPhone.
Yeah.
And now they use, I think, most of their sort of promotion or targeting of it using first-party data or essentially AI in the outside. And I think I can't remember. I heard a headline: their sales were up sort of like 20% plus or something like that on a year on year. And if they can do, if that demonstrates if you've got the right service without using cookies that actually works, then you've got a big addressable market there, because that's an elephant galloping, and it's an enormous market if you get it right. So yeah, okay, good. All right, moving to another company seems to be in exactly the right place at the right time with its software and AI sort of services is Windward, which does basically maritime AI data services to governments and to corporates, helping them in numerous different ways. But things like, obviously, you've got the sanctions imposed on oil for Russian oil. You've also got the problems with Middle East trying to actually, reschedule supply chains, giving visibility into sort of like boats and cargo coming to different places. Plus, you've obviously got all that contraband trying to get into Europe with organized crime, with cocaine and stuff like that. So it does seem to be in exactly the right place at the right time. Can you take us through this one? Because I've never seen a company quite like it, actually.
Yeah, it's a fantastic little business, and just I guess applying big data analytics and AI sort of algorithms to analyzing huge quantities of data about and triangulating sort of and spotting patterns in that data and applying that to the global maritime and shipping market, which is a colossal market, is kind of pivotal for global trade. But perhaps slightly surprisingly, it's quite behind the curve from a technology point of view. So you might not know exactly where your cargo is for like weeks on end, and whereas if you're buying something off Amazon, you can probably track it sort of to within a sort of couple of square meters if you really wanted to. And so the technology is out there; it's just not being applied to this market historically. The early wins that they've had have been, as you mentioned, government customers, so Homeland Security and sanctions, and so the US government being their biggest customer. And that's really, it's about being able to spot irregularities in data you're getting. So all ships above a certain size have to have
it's a bill of ladle or something like that. It's what's on there, isn't it? Supposedly, is it bananas or is it actually cocaine in banana skins?
They have to broadcast their location. They're obviously certified. The country of origin, the country of destination, where they've stopped on the way, which other vessels they've been close to, who the ultimate owners are, who the owners of the cargo. There's a gazillion pieces of data which are relevant, and if you put all those together and then spot patterns, you can spot when something is behaving unusually relative to what you would expect a ship going from that destination to this destination with those characteristics, what you expect them to do. So they're doing something nefarious, and you can alert the sort of customs authorities or Homeland Security or whatever it is. But then the wider sort of longer term application here is just business analytics for freight forwarders and for your big corporations that are shipping things around the world. So you understand how to optimize what you're doing and reduce the cost in the supply chain, and that particularly with things like the Red Sea sort of disruption we're seeing at the moment, that's very, very relevant. To be able to get real-time data to be able to make sort of multi-million-dollar decisions that on the back of it is really, really valuable, and there's not many people that are able to do this, and Windward's going to be set up specifically for this market. So,
and you see just exactly real life examples of where they haven't got the data and it's a problem. Things like Tesla's factory out in Germany had to stop, and I think another automotive facility also did, in Europe. And
so the cost of getting it wrong are massive. So if you've got a tool which isn't, in the scheme of things, is not that expensive, enabling you to avoid those losses, then that's hugely valuable and very sticky. And it's another great example of a business. It's UK small cap. It's software as a service, it's sort of growth company, just derated hugely over the last couple of years into a level which just to us just didn't make sense. And we've been adding significantly to it in the last few months.
Yeah, good. Yeah, I mean, certainly if I was importing some stuff, I'd want to know whether there's a hootie on board or whatever like that. So trying to avoid him. Okay, let's move, just come down to sort of like the level of complexity in software. Let's move into sort of like construction and infrastructure. And it's a very cheap area. Let's turn to Costains, and the whole sector obviously had a problem 5 or 6 years ago in terms of managing large contracts and margins and stuff like that. Can you just briefly talk about sort of like, has the sector learned now, obviously, that it's mistakes which you had in the past, and also specifically about Costain, because it's got it seems to have a big balance, well, a big lot of cash, and I think its pension scheme's largely sorted. Yeah. And could you just in terms of what's the attractions here?
Yeah, I guess we have a positive view on UK infrastructure spending. So we think there's an area where there is sort of cross-party support, and there's some big programs, and notwithstanding HS2 sort of being scaled back, there is a lot of spend going into sort of, I guess, improving the quality of UK
water.
Yeah, whether that be roads, water, and a number of different areas. So, and there's regulatory drivers also, particularly in the water sector, that kind of pushing demand for activity. There's lots of players in this space. You're right. There's this kind of general perception of big risky contracts that are going to go wrong, and sort of shareholders take the pain for that. I think, number one, the industry has learnt from past mistakes and is more effective at contract management and kind of the way that they price contracts.
It does seem to be the case, because there hasn't been a slip up by a major player, has there, recently? In the last 2 or 3 years, I don't Galliford Try or Balfour Beatty.
No, there hasn't. But I mean, I think Kier and before that Carillion sort of had issues historically. But I think the government has also learned from those experiences and know that actually, pushing as price as the kind of predominant factor in negotiations, at the extreme, if you go too far to the extreme for that, you end up with businesses pushing things too hard. That results in corporate failure, which ends up costing the taxpayer more money rather than less money. So I think they've learned from the Carillion sort of experiences where the ramifications of that were sort of pretty severe. So I think the industry is in better shape. The customers' procurement processes are in better shape. And then something like Costain. The reason why we like Costain in particular is because I think it's got a great management team, but it's a pure play on this theme. Where some of the others that you mentioned, they are exposed to this area, but they also have more general construction exposure. So there's more cyclicality to their businesses. This one we think is really sort of it's just on large scale tier one sort of government contracts in those key areas, which we think have got good tailwinds to the spend profile. So that should be a good sort of tailwind to demand, and you can see that in the order book. And as you say, the businesses. It's well capitalized now, so we participated originally when they raised a significant amount of new equity. So for a difficult period for them, which was just as we're going into lockdowns, is when they raised quite a lot of money to sort their balance sheet out. But now that's put them in a pretty good sort of strong positions, and the shares they are not very demandingly priced. The whole sector's been very sort of lowly rated for a long time, and we think that it doesn't have to change that much for this to be a really exciting opportunity from an investment.
Just on a sort of like an optionality perspective, when you run your port, how much cash do you traditionally hold or hold at the moment, Ken, in terms of opportunities? Because if you do have a company that effectively needs a distressed placing, and you like the firm and have been stalking it for a long time, hey, you start sort of like thinking, well, this is Christmas come early.
Yeah, look, it's a fine balance, really. We typically, depending on the fund which we're talking about, we typically have between 5 and 10% cash at any given time. We factor that cash drag into our sort of returns expectations from the funds, precisely for the reason that you're mentioning. It gives us dry powder available to take advantage of opportunities when they come along, and we don't have to realize something in a bad market in order to be able to take that opportunity. And I think the last year or two has really been testament to that being a good idea, because there's been a lot of volatility. There's been some really interesting, attractive sort of valuation opportunities, but they don't last forever. So if you don't get in relatively quickly, as long as you've done the work already and you've built the conviction, and being able to move quickly is really sort of, it's an important advantage. And I guess in the last couple of years, a lot of public sort of small cap funds have had redemptions, and that means they've been forced sellers of things.
Yeah.
So that's given us the opportunity. So if you've got the cash available and you're buying from forced sellers, that's pretty attractive.
Yeah, I wouldn't like to be across the table with you, Ken. I think you'd turn me over big time. Okay, right. Watkin Jones is another one which has been in the sort of construction area, but not in infrastructure. It's in sort of like student accommodation. I think it was its roots, and now it's moved into build to rent and also affordable homes. It used to be a real darling in the house building sector, or sort of multi-residential. I think they call it out in the States, sort of sector. But the shares have come down a lot. New CEO. What's your latest on this one? Because it's trading at roughly around about just over net tangible book actually.
Yeah. So this business we typically try to avoid sort of overly cyclical areas of the market. Because we don't sort of try to call the cycle. We just try to find good companies at good prices where we've got good margin of safety and good and they're resilient. So the construction sector you mentioned before, that's why we like Costain, pure play on infrastructure, rather than the more diversified players which have got more cyclical exposure. Watkin Jones, again, the reason why we liked it within that sector is because it's specifically targeting and it is a market leader in the area of student accommodation where there's big structural undersupply, significant demand from universities and from sort of institutional buyers to build more developments in that area. And they are experts in it. They're known for being very, very good at delivering these sort of projects sort of on time. And if you can't get one of these wrong and get it, then it sort of gets delivered late, because if you miss the start of term, that has all sorts of negative ramifications. So they've got a good name for themselves in that space, and they've also moved a bit into the private rental sector. So specific blocks being built specifically for rental, and those asset classes are attractive for institutional investors, and so they don't really take much balance sheet risk. They're developers. They're really good at that, and they're also been very good at passing off, then effectively backing new developments with institutional investors that want to back those projects. So that's how it has been for a long time. It's a good quality business with good earnings visibility and a good pipeline. The thing which has tripped them up recently has been just the change in the rates environment, and particularly around the LTI crisis and sort of discontinuity in the bond market. What that did was make pension fund investors, who are one of their sort of core groups of institutional investor clients, reappraise their requirements for returns and reappraise their asset allocation, and all that really means is delay, because they're less willing to take on some new contracts until they've sorted out what they're doing in their wider business, and so that's meant that lots of the contracts that Watkin Jones had have been pushed to the right. Business is still profitable. Our industry referencing suggests that they're still very well regarded in that space. We think the sort of investment side of the market will free up in due course. It's just going to take a bit of time. So we think it could well tread water for the very short term, because there's uncertainty on that demand side, but long term we think they're really well positioned. And again, it's yet another one in UK small cap where because of their capability, if that doesn't start to sort of get back to momentum and they don't start to get recognition in the share price for it, they're obviously a potential target for someone bigger who wants to kind of ready-made play in that space.
Yeah, you are seeing you had seen some pension funds buying these companies as well, weren't they? Have their own. I think M&G bought one. I can't remember, some home builder, but yeah, you're right. Now another one which is in the sort of like the services outsell sort of sector is Capita. Now this one I guess is attracting is a turnaround. It was originally I think a Neil Woodford sort of favourite years and years ago, but came off. It again got itself into trouble in terms of sort of contract management, and used to make really strong sort of like profit margins. That's fallen down. What's your latest on this one? Because it still needs to do a bit of balance sheet repair. I think the pension scheme is largely okay, but it's still well respected. It does the London congestion charge and people like stuff like that.
Yeah, so I think this is a classic case of a disconnect between industry sentiment and stock market sentiment for a company. So as you referenced before, the connections this business had, it's had a lot of high profile sort of issues as a listed company and investors that backed it, as a FTSE 100 company at one point, there's been lots of people who have lost lots of money and been burnt by it. So I think lots of people who just don't look at it or have an outdated view of the position of the business. If you speak to people in the industry, actually this is really a sort of tech-enabled services provider, and it's been going through its own significant digital transformation in terms of what it does, and it's now sort of going up against people like Capgemini and Atos Origin, people like sort of tech-focused consultancy businesses to win contracts and winning contracts. So we think that that's kind of good indicator of what they're really doing now, versus what they're kind of perceived to be doing from a few years ago. They've also gone through this is a very late stage turnaround now. They've done most of the heavy lifting. So it's been a number of years, but they're pretty much at the end of their non-core asset divestment program, and as a result of that, and better working capital management and improving sort of contracts sort of management, etc. The balance sheet is now largely repaired, so this is a business that will be into a sort of sub 2x net debt to EBITDA. And that means it's then potentially investable again by mainstream institutions. I think that people get over this is what Capita was 5 years ago, and actually look at what it currently is doing. It's winning contracts. It's much more those contracts are much more profitable. Balance sheet is repaired, but the rating's not really reflecting that yet. New CEOs come in, so the guy's been turning around the business for the last 5 years is stepping back. He's sort of done most of his job, and a more growth-oriented CEOs come in who references very strongly. So we think this is just fundamentally mispriced because people haven't really looked at it recently, mostly.
Yeah, and if you, it makes sort of like I don't know, just over about 4.5% EBIT margins in a sort of long term. If it gets that structure right, what would you expect to sort of to make?
This could make double-digit margins for sure if it gets it right.
Yeah, I agree. Well, that just makes it crazy, doesn't it, when it comes to the sort of valuation? Okay, let's move to another consultant, Elixirr International, which basically, I think it's sort of like a challenger strategic consultant against the likes of Bain and Boston Consulting Group and McKinsey. I mean, you can't go against stronger guys than that. The rest of those American guys have actually been shedding staff, but Elixirr does seem to be, reiterating its trading expectations.
So, Stephen, the CEO, will hate me for characterizing it this way because it's too simplistic. But I view them as a digital transformation consultancy. So they are helping. They're talking at the top level. They're talking board level contacts with big corporates that they're advising, and they're advising them on how to navigate the sort of digital transformation of their businesses in whatever sort of capacity that requires. And so it's change management. So it's a bit of strategy, but it's also selection of technology solutions, it's implementation of technology solutions, it's change and organizational change management. So there's a lot of different components to it. So it's not, yes, at one level they compete with your McKinsey and Bain, those kind of big strategy consultancy houses, but they're also competing with Capgemini and Accenture and people that are sort of doing the implementation. In fact, Stephen, the CEO, used to be at Accenture, I think. So they're just playing into the right part of the market, and they're of a size that that they don't have overcapacity. They can focus specifically on the really exciting kind of growth bits of change. And everyone, I mean, no one would tell you that there's going to be less technology in 5 years' time than there is now.
Yes.
AI is just another sort of theme which is driving need for advice for corporates. People know there's a big thing going on here, but they don't know how to navigate it. So they need people who've got expertise who can help them to sort of handhold them through the journey, and that's what Elixirr are trying to do. So we think it's well-run business, and the way that their partnership model works is there's a lot. All the key rainmakers in the business have a lot of skin in the game, and they're aligned with equity shareholders. So we think we like that model.
Yeah, and I think if investors want to sort of like a data point, have a look at the latest results from Accenture and IBM Global Services, because they specifically highlight that they are retraining a lot of their staff and recruiting into the AI digitization transformation, because they see lots and lots of opportunity over the next decade. Okay, good. Well, let's move to B2B services. We've got franchise brands, which has actually been a bit of a buy and build, and it's sort of like it acquired Filter, I think, a couple of years ago, which does sort of like kitchen cleaning, commercial kitchen cleaning services, and it also has got a business out in the States for that. And also recently, I think it also acquired PeerTech, which basically does hydraulic hoses, I think. Can you take us through this one? It does seem to have real sort of dominant positions in niche industries, actually.
Yeah, so this is a business that we backed when it first came to market. We actually independently had an investment in Filter, which you referenced there, which and then they did an all share merger of the two.
That's right.
So we ended up with a bigger stake as a result of sort of having been on both sides of that transaction. Franchise Brands is run by Stephen Hemsley, he's exec chair. He used to be the CEO and then the chair of Domino's Pizza. So he really understands franchising, and that's what, as the name suggests, this business is in those areas that you're
There's a clue in the title.
Yeah, exactly. But they're doing it through a franchise model. So they're the master franchisor for Filter and for PeerTech and for other brands. And they support the franchisees, but it's the franchisees who are the business owners that are actually implementing the activities on the ground, and they're strongly aligned to grow their businesses. And because of the way that the model works, if they grow their businesses, then Franchise Brands as master franchisor will grow, but without having to employ the capital or employ all the individual people that are doing this to work on the ground. So we really like that model because it's low capital intensity, kind of less cyclically exposed. And as long as your franchisees are ultimately doing well, then you're going to do well. And so it's all about supporting them. And Stephen's got a lot of experience of that from Domino's and other areas. So we think it's in that the pretty interesting kind of resilient part of the market. So just doing things which kind of have to be done, and doing things which, if they're done professionally, will ultimately save you money as an end customer, and that's the kind of strand that sort of weaves its way through the different parts and different brands within their business. And as you mentioned, the Filter business is a US centric business, so it's got a lot of opportunity to grow in the US. And the old Filter CEO is running the business out there. But we think this could be a much bigger business, and it's not on a demanding valuation at all.
Yeah, and a lot of its services, it does seem as though they're regulatory driven, because if you get a pollution leak, you're going to need a hydraulic hose to clean it up for you. You've got no choice. Or likewise, if you're cooking for people who eat food, then you've got to make sure your kitchen oil is clean and healthy and not contaminated. So it isn't as though it's a discretionary expense.
No, it's not. And that's the point. It's in these areas of they're non-discretionary. They have to be done. You're best doing it with an expert doing it, and that's what these guys are.
Good. Okay, well, let's move on to Learning Tech. Again, a bit of a darling that's fallen, quite a long way. Came out with an interesting, inline trading update. What was really piqued my interest, the net debt has significantly reduced. And can you just take us through something? It does seem to be a good sort of turnaround play in that sort of like education, sort of like, corporate training, transformation type industry.
Yeah, I think the big picture here is it's a fantastic global industry where there's just corporates are spending more money overall over the long term on training and developing their people, and recognizing that talent is important. And if you're not treating them as just sort of transactional, so you do care if people leave, it costs you more money to replace them than it does to have to keep them sort of fully trained and make it a good place for them to work. So and increasingly the theme, this sort of pervades a lot of companies, but technology enables people to do that more effectively and more efficiently, particularly with a diverse workforce. So that's the kind of big picture market. This is the classic sort of, I guess I'd describe them as a fallen angel sort of stock. So this is a business which we've known for a long time. We like the area they're in. We like the management team. It's been quite acquisitive over the years, but the valuation has always been a bit too toppy for us to get involved, because it was rated very highly because of the kind of attractive growth dynamics of the market, and the fact that they were sort of growing faster than the market. That's kind of changed dramatically, along with lots of other stocks with similar characteristics, and a bit of cyclical headwinds, maybe a bit more questioning over any of the bits of the business that are discretionary. They bought a big business called GP Strategies, which is a services business, so that diluted the software component of the business, which the market sort of struggled to get its head around a bit, and all of that resulted in the business being derated very significantly. And guess what? That's a great opportunity to get in, because it's still a good business. It's no worse a business now than it was when it was rated on sort of 30-40 times PE multiple, but it's now a lot cheaper, and same team, same market opportunity, probably, if anything, a better market opportunity than it was a few years ago. So we think that there's an opportunity for this business to demonstrate that the acquisition they've made actually makes sense, and that they can significantly enhance the margins of that business, which they're starting to do, and there is evidence of that already. And as soon as the kind of cloud of questioning the cyclicality of the market is removed, then this business can really start to accelerate. And we think that if it does that, the rating will sort of recover quite rapidly.
Yeah, it's currently on only 10 times, so it's great value, even after even the slight tick up last week in the shares.
Yeah.
I would sort of like, again, if you want to sort of like an example of where corporates get their training wrong, which has been extremely high profile, that would be a benefit of these type of services. Just look at what happened to Boeing, because during the pandemic, pre-pandemic, it had a very stable workforce of people who are sort of like tradesmen and craftsmen. Then they basically had the pandemic lockdown. A lot of those guys left. They had to re-recruit, and they've had a catalogue of assembly and build problems since then, because the new staff haven't been properly trained in a regulatory environment. I know these guys do a lot of industrial regulatory training, so it's a very high profile.
Again, it's another thing where it's not just a nice to have and just discretionary, it's a must have for a lot of these companies. Yeah.
Another one which has sort of come out the pandemic is Kooth, which is basically a mental health or telemedicine type business. It's got very good reputation in the UK with the NHS and for schools here to help young people sort of like, cope with mental health. But now has won sort of like two really sort of like, blue chip contracts out in the States, one in California, the one in Pennsylvania, I think. Do you want to take us through this one? Because it does seem to be now getting ahead of steam globally, not just in the UK.
Yeah, this business is doing great stuff. It really hits the sort of S part of ESG. If people are still worrying about that. Yes. It's meeting. Unfortunately, there's a huge unmet need for support for mental health issues in this country and most developed countries. And they're specifically focused on children and young people, where there's sort of an acute issue. And it's all about providing the resources online and access to trained professional counsellors through an anonymized sort of text-based interface online, which can encourage and enable people to seek help earlier, rather than it sort of getting to a point where they need acute interventions later, which is obviously much worse for them as an individual, and also costs the NHS a lot more money in the UK. So that's kind of why they have a right to exist. And the NHS strategic plan kind of specifically highlighted digital mental health services as an area where there was kind of going to be a priority of focus. Clearly, COVID and issues with the NHS capacity has had a bearing on the kind of ability to spend and the speed of decision making, and hence the decision to go to the US makes a lot of sense. And this business, as a result of having 15 years of heritage of actually doing this on the ground in a big market, that they were able to win the state of California sort of equivalent service provision contract, which is a huge sort of $100+ million contract. They won that against who's who of all the kind of Silicon Valley firms that were sort of going up for trying to take on the contract, because whilst they might have whizzy tech and loads of funding from VCs, they didn't have the experience of actually delivering what is a quite complex and very, very critical to get right service to people on the ground over multiple years, and that's why Kooth won the project, and that, you know, so it's really transformational. It's helping to sort of, I guess, massively increase their addressable market and reduce the reliance on the NHS, which, you know, whilst there's good long-term growth in the UK, there's sort of some headwinds in the short term.
Yeah, I mean, it just really illustrates, doesn't it? The barriers to entry for this are much higher than people think, because you need all the historical data and what works in with it, that type of individual, what behaviours and how to approach it. Yeah, I get it. Okay, let's move to a company, EKF Diagnostics, which again has been sort of like through the mill through the pandemic, and it does sort of like blood testing largely for you know, sort of hematology sort of stuff with iron deficiency, and also for diabetes. That's its core business, very solid, recurring revenue streams, a razor type model. And then it's also gone into enzyme production for diagnostics and life science companies out in the States, where it's a bit of a fledgling business, but now just trying to win some early contracts. What's sort of your latest on this one? Because I guess if it can get it right, then it's mispriced.
Yeah, no, so I think you've highlighted it quite nicely. So the original business, the kind of the traditional diagnostic business is effectively a cash cow, which can generate a lot of profit and cash for the business, and it's enabled them to invest in the life sciences business in the States, which is potentially much faster growth, higher margin, and a kind of diversified set of clients. So really exciting if they get it right. I think a lot of the investment has gone in, but we haven't really seen yet the kind of sustained evidence of the traction from the revenue side coming in to sort of deliver the profits. But we think that will happen. And if it does happen, this business is going to be an extremely attractive asset for somebody. You know, it can obviously generate profits and cash and grow standalone, but we think ultimately it's probably likely to be consolidated in due course. And yeah, we think it's just fundamentally the wrong price, partly because of the discontinuity from COVID, which has sort of made people question the credibility of the numbers. They had profits which were specifically related to the pandemic, which I guess people got carried away and sort of extrapolated those into the future when they'd never really given that indication, and so that sort of made people struggle to understand the numbers. And if you look at just look at it on a screen, it looks like it's gone backwards, but actually, you know, we think that the bit that matters is going in the right direction.
Yeah, and I guess it's really, you know, because one of the expertise that you guys have got is that private equity type valuation model. You can overlay it, then it gives you a good perspective of what the business would go for in a private market.
Absolutely,
okay,
and that applies to lots of our companies, by the way.
Yeah. Okay, good. Well, let's move to Diaceutics, which is basically, I think, it collects and analyzes and aggregates data from lots of sort of like labs, blood testing and lab testing around the world, and then helps big pharma not only develop their drugs, but also launch their drugs when it might be sort of companion diagnostics, but finding patients that fit their treatments, immunotherapy and precision medicine. Can you take us through this one? Because it does seem to have a unique data angle that I've never seen anywhere else in the world, actually, anybody doing this.
Yeah, so it's a really exciting business. And it's, as you say, it's sort of using data to either make more efficient or more effective, or potentially kill early the drug development sort of cycle where billions of dollars are being spent. And it fits the theme we really like more generally, which is outsourced services, data, software, information into the pharmaceutical value chain. So rather than taking bets on specific drugs and the kind of binary risks that you get with biotechs, we really like selling into specialist businesses that are sort of doing something quite niche within that value chain, which is being, so the pharma companies can't do as well in-house, and so willing to spend significantly to either save or generate lots of cost or income for them in the future. And the business's transition to the DXRX platform is really about providing a subscription-based service to those pharma companies. So you're partnering with them sort of on a recurring basis so that all their programs will go through and leverage that data analytics capability. I think it's sort of half the business is now in that recurring sort of rather than project-based sort of business model, and that means the valuation of the company is sort of significantly or should significantly benefit from that in due course, because the quality of earnings is much better. They've got a fantastic customer list of big pharma clients, and increasing recurring nature of the business with those businesses, and ultimately they're doing something pretty business critical. But this is still quite a small company relative to what those companies are spending in on this area.
Yeah, well, I mean, you can save them literally hundreds of millions of pounds in their R&D and on their implementation. Never mind improving effectively the label prescription for their drugs if they get the right patients for do trials. Yeah, I agree. Okay, let's move quickly to the consumer. We've got Loungers, which basically does sort of cozy type of all-day dining locations in local areas, and we've also got the old Premier Foods, which does sort of ambrosia custard and Mr. Kipling. Do you want to take us through Loungers first, just quickly?
Yeah, so Loungers is, I think they just announced they've got their 250th site in the UK.
Yeah, that's right. Yeah,
and then in my view, these are the best operators in the sort of casual dining sort of space in the UK. They've really demonstrated that over the last few years. They've really disciplined on rent. Their proposition is a kind of very democratic proposition, so it appeals to lots of different sort of segments of society at different times of day and different. So they can put something in a location which just doesn't work for other competitors, and you can go and get a cup of coffee for similar price to Costa, and you can buy a pint of beer for a similar cost to Wetherspoons. You can get your sort of breakfast, lunch, and dinner for very competitively priced, and people can hang out there, and they're happy for people to do any of those things. They're quite sort of quirky, sort of high street locations, but in an area at a time when
sounds like Starbucks originally.
Well, maybe, yeah, but a bit less cookie cutter than Starbucks, really.
Yeah.
And there's quite a lot of autonomy given to the local management team to work out their local demographic and kind of what works. So it's been extremely successful, and they generate really good returns from a new site pretty rapidly. And in an environment where COVID disruption and lots of oversupply of casual dining has really kind of made the sector overall struggle, they've still carried on growing and doing the right thing. So just proves they're excellent executors.
What about Premier Foods? Because it must be a continued turnaround, I guess, because it used to be. You okay there, Ken? Are you?
Yeah, I'm just being. So I think my room's being required for someone else.
Okay, well, we'll finish on Premier Foods then.
Yeah. So Premier Foods, it's another kind of late stage turnaround. It's one which people kind of perceive to be overgeared and in a bit of trouble, having overexpanded through acquisition over the years. And it's really, the debt's gone, the business is back to growth, and it has a whole host of market leading brands which are pretty resilient in a more difficult consumer environment, and that we just think it's being priced for the kind of old world, and actually it's a business which is now generating cash, paying a dividend, and going in the right direction.
And will somebody buy these guys?
I mean, there's been a lot of M&A in this sector, and obviously there's some huge fast-moving consumer goods businesses that would love some of their brands. So it's certainly possible.
Brilliant. Okay, well, thanks very much, Ken, for all those terrific insights. If somebody wants to invest in one of the Gresham funds, how best to do that?
You can. The open-ended funds and our investment trusts are all sort of available on all the kind of typical platforms, Hargreaves Lansdown, Asia, Bell, etc. So that's probably the easiest way, or through your IFA.
Brilliant. Okay, well, thanks very much, Ken, and look forward in touching base again in about 6 months' time.
Okay, all right. Thanks, Paul.
Bye.
Cheers.